So portfolio management. So first, portfolio means portfolio investment means investment in two or more securities. So before making investment, we should consider two factors: return and risk. First, we should select the securities. Securities are selected on the basis of two factors: return and risk. Okay, so that's why in this chapter, first we have learned how to find out the return and risk of a security, and then we have learned how to find out the return and risk of a portfolio. Return and risk of a portfolio. So first, so we have learned how to find out return. X is equal to P1 minus P0 plus D1 divided by P0. So equity shareholder will get to return in two forms. One is capital appreciation and the second one is dividend. So that's why the formula for return of a security X is equal to P1 minus P0 plus D1 divided by P0. Next, X bar. X bar is nothing but mean return. What? Mean return. How do we get mean return? If it is past data, then we do simple average. So when the future data is given, then weighted average. Weighted average. And then risk of a security. Risk means a possibility of a deviation from the mean. Possibility of deviation from the mean. Risk of a security can be measured using variance, standard deviation, coefficient of a variance. So variance of a security denoted with sigma x square. So sigma x square is equal to summation sigma x minus x bar whole square divided by n, or summation sigma p into x minus x bar whole square. When probability is given, the formula is summation sigma p into x minus x bar whole square. And next, sigma x is equal to standard deviation sigma x is equal to square root of a variance. Square root of a variance. And next, coefficient of variance, standard deviation divided by x bar. Standard deviation divided by x bar. Coefficient of variance is equal to standard deviation divided by x bar. Okay. So instead of formula, we should have an idea how to take columns, how many columns we should take. So when the past data is given, what are the columns to be taken? X bar, x minus x bar, x minus x bar whole square. When the probability is given, then what are the columns? X, P into x, x bar, x minus x bar, P into x minus x bar whole square. So these are the columns to be taken. Okay. So after learning how to find out the return and risk of a security, we have learned how to find out return and risk of a portfolio. So return of a portfolio, P bar is equal to WX x bar plus WY y bar and so on. Nothing but portfolio return is equal to weighted average of a security return. Portfolio return is equal to weighted average of a security return. So but whereas risk of a portfolio sigma P is equal to, so sigma P is not equal to weighted average of a security risk, because while finding out the risk of a portfolio, we have to consider correlation coefficient. How close are the securities? We have to consider how close are the securities. So that's why risk of a portfolio is not simply equal to Wx sigma x plus Wy sigma y. Risk can be diversified. So that's why we have to consider how close are the security. That is correlation coefficient. So that's why sigma p is equal to square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma y sigma xy sigma xy. For example, if sigma xy is equal to 1, if sigma xy is equal to 1, then that formula will be okay equal to a square plus b square plus 2ab. If a sigma xy is equal to minus 1, then that would be similar to a square plus b square minus 2ab. A square plus b square minus 2ab. Okay. So sigma p is equal to, this lengthy formula will be used when sigma xy is other than minus 1 and plus 1 and 0. Nothing but when sigma xy lies between minus 1 and 0 or 0 to 1. Okay, sigma p formula. So when three securities are given, then instead of a plus b whole square, we take a plus b plus c whole square. So what is the another formula? So instead of sigma x, sigma y, sigma xy, so we can take covariance of x comma y. So sigma p is equal to square root of wx square sigma x square plus 2wx wy covariance of x comma y. So this is the formula for risk of a portfolio. So however, so when sigma xy is equal to, there can be 5 cases. When sigma xy is equal to plus 1, then sigma p is equal to wx sigma x plus wy sigma y. So because the reason, risk cannot be diversified. When sigma xy is equal to plus 1, risk cannot be diversified because securities are moving in same direction and in same proportion. So when sigma xy is equal to minus 1, then sigma p is equal to a minus b wx sigma x minus wy sigma y. Okay, so you might get sigma p negative also. You have to ignore the negative sign because risk cannot be negative. So sigma xy is equal to minus 1. When sigma xy is equal to minus 1, you can reduce. So you can reduce the risk to 0 by maintaining a proper weights, by investing money in proper proportions. Okay. So what is the optimum proportion? Optimum proportion wx is equal to sigma y divided by sigma x plus sigma y. Okay. So when sigma xy is equal to minus 1, risk can be reduced to 0. Further, weight of x must be equal to sigma y divided by sigma x plus sigma y. When sigma xy is equal to 0, then sigma p is equal to square root of. When sigma xy is equal to 0, then 2ab part will be equal to 0. So if 2ab part becomes 0, then wx square sigma x square plus wy square sigma y square. Okay. So when sigma xy ranges from 0 to 1 or minus 1 to 0, so then we have to use the lengthy formula. So but when correlation coefficient is other than minus 1, so when correlation coefficient is plus 1, risk cannot be minimized, risk cannot be diversified. But when sigma xy is equal to minus 1, risk can be reduced to 0 for maintaining a optimum weights. So when correlation coefficient is other than minus 1, then risk cannot be reduced to 0, but risk can be minimized. So for that, weight of a x is equal to sigma y square minus 2 covariance of x comma y. So here sigma xy ranges from minus 1 to plus 1. covariance of x comma y ranges from minus infinity to plus infinity. Okay, so there are high chances you might forget this formula. So when correlation coefficient is other than minus 1, risk cannot be reduced to 0, but risk can be minimized. So for construction of a minimum risk portfolio, proportion of a security x must be equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. Okay, done. So next, covariance of x comma y ranges from minus infinity to plus infinity. So covariance of x comma y. So what is the formula for sigma xy? Sigma xy is equal to covariance of x comma y divided by sigma x sigma y. So this is the formula for sigma xy. And next, how to find out covariance of x comma y? Summation sigma dx into dy divided by n. Nothing but summation sigma x minus x bar into y minus y bar divided by n. Or summation sigma p into dx into dy. Probability into x minus x bar into y minus y bar. Okay. So but here, so we have to learn what are the columns to be taken for finding out covariance of a x comma y. So when past data is given, then what are the columns to be taken? X minus x bar, y minus y bar, x minus x bar into y minus y bar. So these are the columns to be taken when past data is given. When the future data is given, x minus x bar, y minus y, p into dx into dy, probability. Okay, so when past data is given, so total of last column divided by n. So but when future data is given, total of last column itself is the covariance of a x comma y. Am I clear? So after that, so we have learned what is the systematic risk. Rule of a dominance. Total risk is equal to systematic risk plus unsystematic risk. So before learning total risk is equal to systematic risk plus unsystematic risk, we have learned rule of a dominance. One security is said to be dominating the other security if it is giving higher return for lower risk, higher return for same risk, same return for lower risk, higher return for higher risk. Then we say the security is dominating. Okay. So total risk is equal to systematic risk plus unsystematic risk. So systematic risk cannot be diversified, but unsystematic risk can be diversified. Only unsystematic risk can be diversified because unsystematic risk is company specific or industry specific. But whereas systematic risk is country specific, it cannot be diversified. Okay. So for the time being, we have told that beta denotes systematic risk. So beta can be positive, negative or 0. So that means beta ranges from minus infinity to plus infinity. So beta denotes sensitivity of a security return with respect to change in market return. With respect to change in market return. Okay. So if a beta is positive, that indicates market and security moving in same direction. If a beta of a security is negative, that means market and security moving in opposite direction. If a beta of a security is equal to 0, that means no relation between the market and security return. So beta can be positive, negative or 0. So beta of a cash is equal to 0. Beta of a risk-free security is equal to 0. So beta denotes responsiveness of a security return with respect to change in market return. So how do we find out beta? So when only 2 periods data is given, change in security return divided by change in market return. In denominator, you will be taking market return because it denotes responsiveness of a security return with respect to market return. Change in market return. So that's why in denominator we take market return. Only when 2 periods data is given, then we use the formula change in security return divided by change in market return. Like in question number 29 or 28, aggressive stock, defensive stock. 20, question number 30. In question number 30, main question number 30, aggressive stock, defensive stock, only 2 periods data is given. In that case, so how do we get beta? Beta is equal to change in security return divided by change in market return. So when more than 2 periods data is given, then beta is equal to covariance of S comma M divided by sigma M square. Or beta is equal to sigma SM into sigma S divided by sigma M. So okay. So these are the formulas for beta. Okay. So later on beta P, portfolio beta. Beta P is equal to WX, beta X, WY, beta Y, and so on. So beta of a portfolio is equal to weighted average of a security beta. Simple, weighted average of a security beta, because systematic risk cannot be diversified. So that's why for finding out portfolio beta, we need not consider closeness of a securities, correlation coefficient. Simply we can do the weighted average of a security beta. So beta of a portfolio. After learning beta of a portfolio, CAPM return. CAPM return is equal to RF plus RM minus RF into beta. Okay. So if a beta is equal to 0, then expected return is equal to RF. That means investor would be expecting risk-free return. Beta is equal to 0 means no risk. So if there is no risk, then investor would be expecting risk-free return. CAPM return is also known as equilibrium return. Sometimes we call it as a expected return. Sometimes we call it as a required return. So this is the return which is required by the investor. If a beta is equal to 1, then RF will get cancelled. Then expected return will be equal to RM. Nothing but investor would be expecting RM. Okay. So without any risk itself, investor would be expecting RF. If investor is taking a risk, then he will be expecting premium. RM minus RF is known as market risk premium. RM minus RF into beta is known as a security risk premium. If a beta increases, required return will also increase. High beta indicates high risk. If risk increases, then required return will also increase. Okay. CAPM return. So why are we calculating CAPM returns? Capital asset pricing model. CAPM return is used for finding out the price of a equity share. CAPM return can be used for finding out the price of a equity share. So what is the formula for P naught? P naught is equal to D1 divided by KE minus G. So P naught is equal to D1 divided by KE minus G. KE means required return. So cost of equity, required return of a equity. How do we get required return on equity? By applying CAPM return formula, RF plus RM minus RF into beta. Okay. So fund manager will be finding out the CAPM return. Later on, he will compare CAPM return with actual return to take a decision. whether to buy the security or to hold the security or sell the security. So if actual return or average return x bar is greater than CAPM return, it indicates underpriced, security is underpriced and buy the security. Fund manager will buy the security. Why the reason? Because CAPM return is the return required by the investor. Actual return is the return expected to be given by the security. Expected to be given by the security. For example, for the risk being undertaken, investor would require only 18%, but the security is expected to give 20%. So then obviously we are going to buy the security because investor would require only 18, but security is giving 20. So buy. Next, actual return less than CAPM return, overpriced, sell. Overpriced, what do we do? Sell. If actual return is equal to CAPM return, then correctly valued, hold. Hold. If you are getting confused, then better find out Jensen's alpha. How do we get Jensen's alpha? Jensen's alpha is equal to actual return minus CAPM return. Actual return minus CAPM return. If it is positive, buy. If it is negative, sell. If it is positive, it indicates security is underpriced. If it is negative, it indicates security is overpriced and sell. If it is equal to 0, correctly valued, hold. Okay, Jensen's alpha. And we have seen one more comparison. What is one more comparison? Actual market price. This time we are comparing market price, not returns. Actual market price is greater than theoretical price or CAPM market price. What? CAPM market price, nothing but market price which has been calculated using CAPM return. So that is also known as theoretical price. That is also known as equilibrium price. If actual market price is greater than CAPM market price, so security is said to be overpriced. For example, as per our theory, so the market price of a equity share should be 180. But whereas in the market, the price of a security is 200. So that means security is overpriced. So what is action? So when security is overpriced, action of a fund manager would be sell. If actual market price is less than CAPM market price, underpriced, then what? Buy. If actual market price is equal to CAPM market price, then correctly valued. Okay, hold. Okay, so we have seen this comparison between actual return and CAPM return, and then market price and CAPM market price. Okay, so later on, after completion of a CAPM return, we have seen arbitrage pricing theory. In arbitrage pricing theory, we are considering premium for various factors. Premium for various factors. Okay, so arbitrage pricing theory is equal to RF plus beta 1. Nothing but beta 1 means sensitivity of a factor 1. So the factors might be GNP, inflation, industrial production, book price, etc. Okay. So RF plus beta 1. Beta 1 means sensitivity of a security return with respect to factor 1. Sensitivity of a security return with respect to factor 1 into premium of a factor 1. Premium of a factor 1. F1 means premium of a factor 1. So RF plus beta 1 F1 plus beta 2 F2 and so on. So okay, we consider premium for every factor which is going to affect our security return under arbitrage pricing theory. So that's why RF is equal to beta 1 factor 1 plus beta 2 factor 2 and so on. So after arbitrage pricing theory, so we have learned Sharpe ratio. How do we get Sharpe ratio? What is Sharpe ratio? Rp minus Rf divided by sigma p. It denotes excess return per unit of a total risk. Excess return per unit of a total risk. Rp minus Rf divided by sigma p. Higher the Sharpe ratio, better it is. So ranking will be given, okay, on the basis of a Sharpe ratio. So highest, rank 1 will be given to the security which is having a highest Sharpe ratio. So Sharpe ratio is equal to Rp minus Rf divided by sigma p. It denotes excess return per unit of total risk. Next, Treynor's ratio, Rp minus Rf divided by beta p. So Treynor's ratio, it denotes excess return per unit of systematic risk. Excess return per unit of systematic risk. Okay. Next, Jensen's alpha, actual return minus CAPM return. So after learning Sharpe ratio and Treynor's ratio, next, security market line. Security market line is nothing but graphical representation of CAPM return. It denotes the relationship between security return and systematic risk. Security return and systematic risk. Next, CML, RF plus Rm minus Rf into sigma S divided by sigma M. So CML, capital market line, denotes the relationship between security return and total risk. Security return and total risk. Characteristic line, RS is equal to alpha plus beta into Rm. Characteristic line denotes the relationship between security return and market return. Security return and market return. Okay, so security market line, capital market line, and then characteristic line. Okay, so after characteristic line, Sharpe index model. So Sharpe index model, total risk, sigma S square. Total risk is equal to systematic risk, unsystematic risk. Unsystematic risk is also known as residual variance. So how do we get systematic risk? Beta S square into sigma M square. We cannot simply take beta S square because beta is a ratio. Sigma S square is a percentage. You have to convert beta ratio into percentage. So that's why we are multiplying beta S square with sigma M square, variance of a market. Unsystematic risk is equal to sigma S square minus beta s square sigma m square. Okay, so next this is the security. This is the formula for security. If it is a portfolio, total risk beta p square, systematic risk, unsystematic risk. Systematic risk formula beta p square sigma m square. Here sigma p square minus beta p square sigma m square, or w a square unsystematic risk of A, and so on. You might forget this formula. So unsystematic risk of a portfolio. Unsystematic risk of a portfolio formula WA square unsystematic risk of A plus WB square unsystematic risk of a B, and so on. Unsystematic risk is also known as a residual variance. Residual variance. And so another formula, covariance of A comma B, beta A beta B sigma m square, beta A beta B sigma m square. Okay, so these are the formulas we have learned in portfolio management. Am I clear? So next, additional question number 7. Maniteja, please join again.